This is a huge, huge point for many traders and investors right now, whether or not the yield curve, whichever part you look at, 2s, 10s, 3 months, 10s, 5s, 30s, whether or not it still is as reliable a recession indicator as it has been in years past, given the massive amounts of central bank intervention over the last decade plus.
Yeah, I think we ignore the bond market at our own peril. Of all the indicators, the bond market tends to get it right most often. And so what is happening here is it's a bond market that's pricing in a lot of policy tightening, but policy tightening that's coming with a slowdown in the economy. And so that's a troublesome position to be in. So I would take it very seriously. Now, you make the point that the 3-month 10-year has not inverted. That's the one we should focus on more. But we listen to the Federal Reserve. They're likely to invert that within months. So it's not a timing tool, but it certainly is a harbinger of future economic woes.
So if it's a harbinger of future economic woes, is it fair or not fair to say that when the NASDAQ pulls back by 35 to 38% from record highs, that it is expecting already that recession and that the bounce we've been seeing is what we see on the other end of a possible recession?
Well, we're probably not there yet. And let's look at it from the S&P 500. If you look at the average return of the S&P 500 during the last 10 recessions, or peak to trough associated with recessions, it's negative 31.9%. The S&P peak to trough has done 22.4%. So peak to trough. So we're getting there. Most of the move in the S&P 500 has been a valuation adjustment as interest rates have moved higher. Now we need to assess what a slowdown in the economy means for earnings. So, for investors, it's probably too late to get bearish. Trying to time these things is going to be hard. But in order to get to a market bottom, you probably need to adjust for earnings, and you need to see inflationary pressures come down and the Federal Reserve to provide greater clarity on where the terminal rate is going to be for Fed funds.
Are you seeing some of those inflationary pressures come down from a forward-looking perspective? We've made a huge point, as have many experts, pundits, and whatnot over the past several weeks and months, that some of this economic data like PPI, CPI, GDP are backward-looking. Is the forward-looking stuff better or worse?
Better. I mean, goods inflation is going to moderate here. We've seen commodity costs come down. Shipping costs have come down. Actually, what's very interesting is the bond market's expectation for inflation. If you looked at a 1-year inflation break even, which is the difference between a nominal treasury yield and a treasury inflation protected security, if you looked at it in May, the 1-year inflation break even, the bond market's expectation was over 6%. As of yesterday, it was below 4%. So that's a huge move. The 10-year is very much within the Fed's comfort zone, the 10-year inflation expectation. So inflation will moderate down. The problem is it's not happening fast enough, and you have a Federal Reserve that's going to be basically driving, looking through the rearview mirror, raising interest rates into a slowdown, which is typically how cycles end. And so is there a path to a soft landing? There is, but it's always been narrow, and yesterday's CPI report makes it even more narrow.
And Brian, before we let you go, really quickly, do you expect that the Fed will raise interest rates by a full percentage point at its July meeting?
It seems likely. And, for investors, you talk about what's been priced in. I mean, the market gets ahead of these things, and the market expects the Fed to get the funds rate to 3.5% by the end of the year. So again, there's your inverted yield curve between very short rates and long rates. But interestingly enough, the bond market's starting to price in a Fed that's going to have to ease in 2023. So, for investors, it's policy tightening, it's slowdown. But as we talked about, we've priced in a good amount of it. There'll be another side to this, but there may be some more challenging days ahead.